Let's talk about ECB today. How do you see the macro going forwards?
Yeah, so it's interesting. Obviously, we're almost certainly going to see the rate cuts, everyone's saying. The ECB signalled that very clearly. I think it's interesting because they've sort of, they're jumping gun a little bit. If you look at some of the key indicators that they're sort of watching, whether it's sort of, obviously the wage growth story, the service inflation story, which is still quite high.
4%.
Yeah, so that's, but more positively, obviously the credit transmission is quite weak. So that sort of supports the outlook for rate cuts. So so after that, our base case is that we'll still see 3 rate cuts this year. But obviously, as everyone's saying, as you've been saying this morning, I mean, it's data dependent, right? So we'll have to wait and see how that plays out.
Yeah, that's slightly more than the market is pricing in. Market's at 2.5. It feels like the narrative is changing regarding the ECB towards higher for longer. What sort of a credit impact is that going to have at a sovereign level, but also corporate level as well?
Yeah, I mean, actually, it's interesting. So for us, when we look at it, I mean, rates you've got to remember, rates are a lot lower in the Eurozone than they are in the US, right? So the impact is much less. But at the same time, you've still got a lot of fixed rate debt, which still has to refinance. And you've got a lot of mortgage rate in certain countries, mortgages which are sort of still fixed rate. So it obviously varies depending on which countries you're looking at. So there's still some sort of, there's still some... The rubber hasn't really hit the road fully yet in terms of the rate hikes that we've seen, and so obviously that feeds through to impacting cash flows for corporate credit, for instance. And while everyone's seen this coming down the road for a long time, there are still some vulnerabilities, but it's sort of systemically, it's not as we don't think it's as important as it might have been 2 years ago.
What happens when the rubber does hit the road? How bad is the credit climate going to turn?
No, I don't think it's
still benign.
I mean, the companies and sovereigns, we've had a lot of time to sort of, prepare for this. So, depending on where you sit in the credit spectrum, you have flexibility or greater or lesser flexibility to handle this. So, if you're talking about investment-grade corporate credit, you've got a lot of discretionary cash flow. If your interest payments are a real burden because you're a capital-intensive industry, you cut back on some of the shareholder-friendly payments, for instance, or capex. If you're in spec grade, it's actually much harder, right, because you have fewer levers to pull.
Yeah. Let me just ask you about France. The sovereign was downgraded by S&P last week. I think that was maybe not much of a surprise, but within certain parts of the market, people were looking at the decision and probably refocusing on the debt dynamics of a very large European economy going forwards. What knock-on effects does that have for the corporates? I know that there were subsequent banks ratings downgrades as well, but how do you see the outlook as well?
Yeah, I mean, obviously it's a very high-profile rating action, and as you say, I mean, we've explained very clearly. The fiscal, the fiscal consolidation hasn't been as good as we were previously expecting under our base case, and so looking further out, the budget deficit is still higher than even the French government was targeting, at the end of last year. So that's all fed into our view, and also the political fragmentation in France. To our mind. Suggests that actually it's going to be harder for the government to actually consolidate the finances in the way that we think they need to. In terms of what the knock-on impact is, I mean, it's very limited. I mean, in terms of the real impact on financing costs. I mean, you've seen, CDS in France are still trading as low as they have been in the last year. Spreads against Germany haven't, moved. They've moved very closely together over the last year. So, in terms of the real market impact, I mean, it's not that significant at this point.
How closely should we be watching the real estate sector in Europe? Again, I remember when we had all these banking concerns around the time of Credit Suisse going under, people started getting very worried about the state of commercial real estate, but things haven't really gone as bad as many had foreseen or anticipated.
Yeah. I mean, again, it's one of these areas that everyone can understand what the sort of real estate is, capital-intensive sectors. It's the most exposed sector to high rates, right? So, in certain it's very much idiosyncratic risk is the way we look at it. It's the real estate developers who are who have actually their finances are not as liquidity isn't as strong as it needs to be to actually sort of wait out a period of much higher rates. So, we don't see it as systemic in Europe. And also, you've got to remember that actually, the European banks are well capitalized, and they have the biggest exposure to real estate in Europe. It's not like in the US, where actually the regional banks have a majority of the exposure to a lot of commercial real estate.
That